and welcome to Fidelity Connects. I'm Pamela Ritchie. Billionaire Elon Musk has found a new home in Washington as a senior advisor to the president. And he's been cracking down on what he calls wasteful government spending via the DOGE, or the Department of Government Efficiency. After years of well above average growth, what might a contraction in government spending mean for markets and for the economy? Joining us now to discuss her latest sector thesis and how it may or may not find its roots in the actions of DOGE is Fidelity Director of Quantitative Market Strategy, Denise Chisholm. Hi, Denise. How are you? Great to see you.
Hi, Pamela. It's great to be back.
Delighted to have you here, and we'll invite everyone to send their questions into you over the next half hour or so. So government efficiencies, yes, this is coming in the form of a lot of layoff announcements, actually. Mm-hmm. Talk us through a little bit what it's meant historically to have less government spending in the markets.
Yeah, it's interesting because you have the data going back to the 50s. You can either look at overall federal outlays, or you can look at government goods and services spending, which is part of the GDP accounts. And you get this same paradoxical relationship. So if you had perfect foresight and knew we were sitting here today and we know that next year, in the next 12 months, government spending is going to contract, what you find is a higher market, higher odds of GDP growth, and higher odds of earnings growth than the reverse, if you were right and government spending grew at top quartile levels. So you have this differentiated relationship that we see a lot in the data sets that I analyze, which means that as much as you think that this is an impact, history is basically waving a statistical flag in your face saying it doesn't usually work like that. Either this isn't the key variable, or there's something else going on. And even if you're thinking that, well, this is biased by recessions, even if you look outside recessions, you will still find that earnings growth is higher, better, stronger, as is GDP, as is the market, when government spending contracts or is lower. So it's a fairly linear relationship. So almost the less spending there is by the government, the more likely the private markets are to grow. So I think if you think about going back to Econ 101, whether there's two competing theories, one, which is to say that fiscal spending is stimulus for the US consumer, and it certainly is on some level, or two, that the public sector, or the government, crowds out the private sector via spending, and that in and of itself has consequences. I'd almost say when you look at the historical data, you find a little more empirical support to the crowding out. So it may be, if you sort of narrow this down to what does it mean for the markets, it might mean a lot less than you think. And in fact, it actually might be a bullish precondition for private growth expansion.
That is fascinating. And you mentioned something about recessions there. So just to bring that in, you assume that more government spending happens historically if you look back over periods when there is either a recession or some sort of shock to the economy. So it almost spells bad news in the rest of the economy, government spending. Is that right?
Right, exactly. So the paradoxical is definitely pulled via the tails. If you knew that government spending was going to increase, let's put it that way, that is usually the point in time when when the economy is contracting, because that's when it needs it. But even if you pull out those tails, you still see, you narrow the band, right? You narrow the quartiles in terms of growth, but you still see this paradoxical relationship of the lower government spending is, the more likely the economy is to grow.
Wow, that is absolutely fascinating. Okay, so let's put it all to work in what we're seeing going on right now. That we actually got a bit of news on initial jobless claims, to the extent, are some of the layoffs playing into the weekly initial jobless claims. I don't know, would you say not yet? You don't see it not yet? That was sort of my guess. What do you think?
We're not seeing anything yet, especially not from the DOGE cuts. I think that the estimates right now are at about 1% of the federal workforce. And just to contextualize that, we did have, we talked about the data going back to the 1950s, but we also have a fairly recent experience with sequestration in 2013. Now that saw a peak to trough contraction in government spending of 7%. And I think it was a peak to trough contraction in federal employment, and this is ex-census, ex-postal service, of almost 5%. So that was a bigger magnitude than currently what we're talking about. And that didn't have an impact on the market. The market essentially went straight up that entire time. Consumption growth accelerated that entire time. And interestingly enough, overall payroll growth accelerated that entire time, meaning that the private markets, from an employment perspective, picked up the excess slack from the public layoffs. So again, that was a much deeper contraction that we lived through. So we do have some experience to show that, again, this is certainly meaningful to the individuals that it's impacting. But when you step back and you look at the broader economy, the broader markets, broader, constructive nature of earnings growth, it tends to have less of an impact. And in fact, can't overwhelm the rest of what growth is sort of in the system already.
So growth in the system already, growth may be okay. So where will we, is this a productivity story, or where, if it's not sort of to stimulate growth necessarily, or that's not the main point of it, where do you see it?
Yeah, in some ways, I think the productivity argument from an argument perspective is the right one to think about, because right now, DOGE isn't as impactful on the overall federal deficit as you would want to see that as the benefit. So we're not there yet. Who knows exactly where it will go, but it's hard to say that the benefits or the harms in some ways are out of like what is sort of very narrow bands. So the argument would be on any wasteful spend, even though the magnitude is not particularly high, to the extent that DOGE can root out wasteful spending and it can reallocate that capital to a better use of capital, that's sort of the definition of productivity. So it really is more right now a productivity argument as opposed to either a fiscal stimulus or harm argument.
That's so interesting. I mean, it seems really, really drastic when you read the headlines, and painful, as you mentioned, for the individuals. So I was sort of wondering where it will all be felt within all of this. And there's more to discuss on everything you've just pointed out. But where are the sectors that will be feeling kind of a mix of what we're seeing on the DOGE side of things, and I guess sort of the aspects of deregulation and so on? Has it shifted your sector outlook?
So no, I wouldn't say that it has shifted anything in my sector outlook, but I will say that the check boxes keep stacking up for a sector that I think is likely leadership in 2025, which is financials specifically. So deregulation is certainly a big story in 2025 that could potentially lift multiples. But now we're also starting to see some economic indicators that we haven't seen in quite some time be beneficial as good leading indicators to financial earnings growth inflection. And that is back to what is very different this cycle. Even though we did not have a recession, small businesses experienced a recession-like credit contraction. You could see it in bank willingness to lend, especially down the cap spectrum. You could certainly see it in the small business credit hard to get survey. We have finally seen an inflection in that survey from recessionary levels all the way back down to bottom quartile levels. That historically bodes really well for an acceleration in loan growth. And loan growth is only growing right now at around 3-ish%, which is pretty much at the bottom of any time during the last decade. Let's sort of take off the COVID contraction. So loan growth has been quite poor. And what you find is, to the extent that this is a reliable indicator where we finally have some credit relief in the area that we have been waiting for to see it most, that bodes well for loan growth, which bodes well for financial earnings growth, which bodes well for relative performance of the stocks. So I think as much as, coming into this year, the story for financials was maybe deregulation is a boost, but really you had a good valuation story. You had a good relative earnings growth turn story. You had a good credit and interest rate story, and you had wide valuation spreads. Now you're adding yet another catalyst, which is to say that we are finally seeing some of the credit contraction, again, only in the small business sector, only in the small and mid-cap bank sector, finally show some relief, which is a good corollary to earnings growth, which I think creates even a more positive risk reward.
So interesting. Finally, it's less of a brakes on the economy, and that can come in. Deregulation, even further. I mean, well, I'm thinking Basel III, which is actually an international regulatory standard, and it's been paused, or actually maybe chucked out. I think where a lot of other nations are kind of thinking about pause on that. It basically ties up more capital for banks, and arguably, some people will argue that's seen the private credit markets pick up some of that. I don't know. I'm kind of curious how this all fits together. So that particular international deregulation, regulation being pulled back along with the others, it just means more capital is allowed into the economy, essentially. What does that also mean for banks?
Yes, I think that it's good news. So when you think about what Basel III might do, it was the, holding over banks' heads of this is the potential, which is to say that you will have to have more capital than you have right now. So in that, again, uncertainty of what's going to happen, banks were much less willing to lend, right? And the market was much less willing to give them a multiple because returns were uncertain. How much capital you hold determines what ROE you can provide on your loans, which determines your lending book. So these are definitely all related things, and it's not necessarily the fact that deregulation is something that has to go from here, but it's the lack of further regulation via Basel III that I think not only improves the potential to lend, which I think is one of the reasons why that survey inflected, but also the way the market interprets it, meaning that you should see multiple expansion. So you could get that dual tailwind, right? So now all of a sudden your lending is better, your earnings growth from lending is better, and all of a sudden the market has more confidence that your ROE or your mid-cycle ROE could be higher, which means that your price to book multiples can be higher as well. So again, I think that this is a real impact in 2025, the deregulation nature of this administration versus the prior administration, I think just works certainly with the bull thesis on financial stocks.
Okay, fascinating. And I mean, that was what we're going to clip, the new leadership could be financials. That was it. That was your lead. Okay, let's talk about the administration, some of the players at Treasury. There's a big interview with Scott Bessent this morning on some of the financial news. There's other people there. It was interesting what he was saying. You have instructed us and told us his background. He's a bond trader up there. The interviewer seemed just so excited to be talking to a bond trader at Treasury. It was a totally flipped situation. But he did say that there isn't going to be a whole lot of change in terms of issuance for longer term bonds, which I think a lot of people were watching because of the 10-year.
Yes. I think that the market participants were either concerned or excited, depending on which side of the curve you were on, whether or not the Treasury was going to go from dominant bill issuance to dominant bond issuance, meaning out the curve, which would create pressure for a higher 10-year Treasury. And he essentially, I'm going to read between the lines and say, walk that back a little in the sense that I think that it will come at some point, but that switch in selling is likely later than maybe market participants were worried about. And he said specifically that he didn't want to compete with Fed selling, right, or the QT that is going on. So maybe some of that timing is related to when QT will eventually end.
Okay, so let's talk more about that. So QT is the way that the government is getting rid of some of the stuff that it's sopped up, ultimately, or being less tight with it and letting it back into the market, so they don't want to all be selling at the same time. But they also mentioned a couple of thoughts about Jay Powell, about the Fed. What do you think of that relationship? Again, interesting market participants sort of coming around the table.
Yeah, it's interesting to have, again, we've gone very quickly to the academic side. I think over the last 20 years that I've been watching markets, and we don't have a lot of practitioners at the table often. So I think that this is fairly new. And to have a conversation between a capital markets participant who is now in the administration with Jay Powell, who is, sort of more academic in nature and trying to corral his reserve board, I think can only be beneficial to have both academics, so the theory of what might happen when we are selling, combined with the practice of what happens to market participants when you sell, is, I think, a really strong position for the overall Treasury and the overall Fed.
Right, really interesting. And his deputy, you just had some knowledge about the deputy. So it's sort of the filling out of the Treasury itself.
Yeah, how interesting. His deputy is a strategist that I have followed, I think, the entire time I've worked. Jason Trennert, who was originally an ISI equity market strategist who started his own firm, I think back in 2007, named Strategas, which I think everybody might know the name and follow. Excellent. He was actually tapped to be Bessent's deputy Treasury Secretary. So I think that we have more and more capital markets experience in political roles, which I think can only be a good thing for how all of our policies are formed.
And on top of that, it just makes you wonder from sort of around the world, those watching such experience sitting within capital markets, now sitting in the roles of political leadership. I mean, if you were to sort of do a quick span of the world, is there anywhere else around the world that has that sort of market knowledge participants actually making the policy at this stage?
I don't think we're there yet globally, but it could end up being a fast follow, right? I mean, the pendulum does usually swing, right? I mean, if Greenspan was kind of the ultimate practitioner in some ways, we've swung to the more academic, theory-based, and maybe now as a globe, I think that we might be either swinging back or bringing it at least more into balance.
Yeah, that's so interesting. Okay, so let's go back to the credit story itself and some of the catalysts that are here. So the deregulation is obviously massive. Yeah. What about the rate story itself? I mean, we saw all the cuts at the end of last year from the Fed. And what sort of, interest rates actually went up on that in a lot of cases for a lot of sort of consumer stories. So it wasn't a necessarily immediately easy time. What are we coasting into now from that perspective?
Yeah, it's interesting. I think the market is still concerned about inflation, and I am less concerned generally than the market. I do think that the bounce in the CPI that you saw is kind of smacks of residual seasonality. So we've seen this in Q1 before, and residual seasonality is just after you know that prices go up, in the first quarter, and layoffs usually go up in the first quarter after sort of Christmas hiring, and you adjust for what you think is typical, you still end up with this seasonal pattern. And that's what people call residual seasonality. So that looks to be a little persistent in the CPI and in a lot of the economic data getting released. And it's all around the fact of COVID. Whenever you have kind of any intrinsic crisis in the last 5 years, which is what you use to seasonally adjust data, you end up with these biases that you can't quite adjust for, even though you want to be true to the mathematical averages that you have. So I think that we're in a situation in some ways why the market shrugged off the CPI a bit is that I think you had a lot of residual seasonality. Ironically, a lot of the PPI components that go into the PCE deflator, which is what the Fed watches, were much lower. So you could even end up with a situation of a 0.4 core CPI, but just a 0.2 PCE deflator, which is much more amenable to what the Fed is saying. So back to the rate story, I think that we're seeing a little bit of a hiatus here where rates aren't going down nearly as fast as they were in the beginning of the year, certainly on the short end and then back on the long end. But we might see that pick up in the back half of the year as inflation continues to decelerate and the Fed, reduces its restriction at the same time, because it doesn't want to have a residual tightening of monetary policy as inflation decelerates. But we'll see.
I mean, I'm just trying to, that wouldn't be great on some level, would it? I mean, it would be great, obviously, inflation is coming down and the Fed were to adjust. But what if inflation comes down sort of well below the sweet spot for equities? And what are the implications?
Yeah, so there's definitely a concern in economists that are worried about one, passive tightening, right? So if inflation comes down and the Fed does nothing, that basically means that monetary policy got more restrictive, or the Fed's making a policy mistake. The interesting point, historically speaking, is that generally speaking, the Fed gets it right within a window of time. And those policy mistakes that happen are usually more sustained and more durable, and they usually don't feel the effects until 5 years from now. So if you think about the financial crisis, which was in 2007, the policy mistake was really in the early aughts when interest rates stayed too low for too long and didn't catch up quick enough to sort of lead to that housing bubble, the market bubble, and then the collapse, which was more because of the leverage that we had in the system at the time. So to the extent that the Federal Reserve now ends up being too restrictive for too long, eventually the problem associated with that is likely that the next crisis is deflationary, not inflationary, which in my opinion is much worse for the markets, but it might not happen for another 3 to 5 years. Again, you don't know. So the end game might be worse, but I'm not sure that this is going to be a big driver of the next 12 to 18 months. I think that that's most likely driven by earnings growth.
Right, which seem to be thus far in line. There's a question rolling in here. It's sort of assuming that you think there is confidence in the markets. This is the question. Do you think confidence in the market will accelerate growth in stocks and bonds equally or almost equally?
Could. So I would say the confidence in growth, let's call that sort of animal spirits, and that usually begets the virtuous cycle of more growth. I don't know that that would be good news for the long end of the bond market. So what you find historically, usually when the Fed cuts, the long end does go down. So that happens 70% of the time. 30% of the time it does not. The long end goes up, which is sort of what we've seen over the better part of the last 6 months. We'll see if that's true over the full cycle. But usually when the long end doesn't go down, when rates don't decrease, it's because there's growth. So the higher growth expectations are, the more, I don't think bonds are a sale or a short, but I think it's going to struggle to keep up with stocks. I mean, it might be bond beneficial. And you get that strong coupon, right? The average returns historically in bonds, and by average returns, I mean long-term treasuries, are about 7%. So we're call it 4.5% coupon. Maybe you get another couple points in appreciation. You're at average, right? So I'm not saying that bonds are a short here or they're a sale, but I do think given the earnings growth setup and a lot of indicators inflecting to the positive here, I think it's going to be really tough to keep up with the equity markets.
Okay, that's really interesting. It's really hard. So what else in the sector side of things? So if financials look like leadership, and that's your call, what else is there? Consumer discretionary, you've been talking about for some time. It's a rate story as well.
Yes, it definitely is a rate story. So I think it's been, side shelved a little over the last couple of months if rates have stayed stickier. But I do think it's more than a rate story. It's a valuation story. So the derating that we saw last year, while free cash flow was strong, while earnings was strong, the stocks just got cheaper and cheaper. As you went down the cap spectrum, yes, consumer discretionary outperformed, but they were basically flat to underperformers in the beginning and middle parts of last year. So any of the resurgence that we saw in relative performance was very short in the span of the last 3 to 6 months. But I think that provides an opportunity because valuation is interesting. And this is true in financials as well, and not true in energy, if you ever want to talk about a sector that I don't like. So what that valuation provides you is a really strong risk reward because what you get is above 70% odds when you're at that valuation level, regardless of what fundamentals do.
Really?
So that's the situation, the math I see with the data that we had going back to the 60s in consumer discretionary. When you're at bottom quartile relative free cash flow yield, so the sector's cheap, when you're at that quartile, you have above 70% odds if earnings growth contracts or if earnings grows. So we're in the earnings growth situation, so that's a positive, but it's not much more of a positive than the earnings growth contracts situation, ironically speaking. So it just shows you just the power of valuation that has been predictive historically that you can rely on. It doesn't necessarily mean that the sector is going to outperform, but it does mean, at least statistically speaking, your downside is more limited, which for me, if you want to statistically interpret, it means that you as an investor are paid to wait. So you have little downside, you have an upside skew, and you can sit around and reassess the data on an ongoing basis. And we're still in strong valuation support for consumer discretionary, and earnings growth is still strong as well.
Okay, really interesting. So round it out for us. So financials, consumer discretionary, what's your third top?
Technology still. I do think that technology is cheap enough on free cash flow because free cash flow has been so strong. And valuation really doesn't dissuade me because I think that the growth rate is durable enough that mid-cycle earnings, I think, are probably too low from an expectations perspective, which means that mid-cycle multiples are actually lower than you think, which means valuation is in a headwind. And growth stocks overall, this is outside technology, on a large cap basis are actually in some of the bottom tercile of the data that I see growing back. So even if you think about technology and we can pick on individual stocks, you don't see it broadly in the technology sector, and you don't see it broadly a valuation disconnect in the growth sector. So I think technology stocks are still a positive risk reward as well. So the top three would be financials, consumer discretionary, and technology in no specific order.
And I would like to talk about the sector that you don't like because it's energy, and yeah, we're fascinated by that. How come?
Yeah, so there are a lot of reasons, and in some ways, if anybody's listened to me before, they don't change. So people do want to buy the sector now in a mean reversion play because it underperformed so much over the last 12 months, and that's statistically not the time you want to buy it. You actually see positive momentum in the sense that once the stocks are underperforming, they're underperforming usually for the next year as well. So that's a trend that tends to be persistent and sticky. But there's a lot of red flags in the data, namely that we just have not renormalized from the really strong, excessively strong fundamentals that we saw in 2022. ROE was as high as we've ever seen it. Free cash flow was as high as we've ever seen it. Operating margins were as high as we've ever seen it in the data that I have going back to the 1960s. So we're still declining from that. You do not, as an energy investor, want to get in the way of declining fundamentals. Valuation has not statistically provided an offset. Energy is one of the only sectors, again, unlike financials and unlike consumer discretionary, where you tend to get trough multiples on trough earnings. So you could potentially get dual headwinds, unlike the dual tailwinds we were talking about in financials, where fundamentals are still deteriorating and not turning yet. And you actually might get valuation compression if we're not at trough free cash flow. So the risk reward still looks negative. And I'd add in the fact that production, especially when you look, over the last year and you roll the data, in the US is still strong. And I know that there's a big contingent out there that says, yes, but the Permians, the shales are peaking and US production is finally slowing. I think that is necessary for outperformance, but not sufficient yet. Okay. I think it's indicative of the fact that excess capacity is still so high. So yes, we absolutely need to shut in capacity because the excess capacity is high. That will happen. That's a bullish precondition, but it's not enough to make the stocks turn.
So I want to just finish out with a bit how we started out and some of your research this week. Economically, government spending, in fact, crowds out the private sector spending. And so what we're looking at now is it looks like less fiscal spending, or at least a path and a promise towards that. It's hard to know. But the upside to that seems to be that we will see the private sector just take the baton.
Yeah, I think it's one of those, statistical arguments that we talk about all so often. I think what you see in the headlines, what is more likely to be the intrinsic driver is not whatever you read about in the headlines. We talked a lot about tariffs. We're now talking about DOGE and government spending. You got to keep your eye on the critical driver, which is to say earnings growth, GDP growth, the economy overall. As you look back and you say, if 2022 was either a hard soft landing or a very soft hard landing, we landed, and we could be in the beginning to mid stages of what could be a decade-long earnings growth and economic recovery.
Fantastic. Denise Chisholm, it is always a delight to speak with you. Thank you very much for putting some of the specific headlines that we're hearing right now into an investment thesis. It's great to see you as always.
Always great to be here.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed, their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again, and see you next time.